Make sure to watch this whole video if you want to find out exactly how we saved our client over £125,000 in UK tax. And we've done this for many clients. That's not the only client. I'm just using this one client as a case study example. But, we've done this for many clients. And if you watch and listen closely, you'll start to understand how this can potentially help you as well. Before we go on, don't forget to like, comment, share and subscribe to our channel. My name is Omar. I'm a chartered tax advisor, and we as a firm, we assist our clients, business owners and clients of accountants with inheritance tax planning, group restructuring, property investments, best structure, international tax issues and the rest of it. So if this is something that you need some assistance on, then feel free to reach out. My email address, I'll put it down below. Now, if we get straight into it, what I'll do is I'll first explain the scenario, and then I'll explain what the client and the accountant were going to do, and then how we implemented a different structure, and therefore that's where the tax savings would be calculated. So to introduce the scenario, we have a client, a business owner, and his accountant who approached us. And the business owner, the business started to make large amounts of profit. So first couple of years, 50K, 100K profit, and then started to jump. So 500K profit, 750K. And then the year they approached us, the accounting period, the profit for the year was close to 1.5 million. So, business is doing well. And what the business owner wanted to do specifically is, you start, and this might be you as a business owner. Many cases we see like this, or if you're an accountant watching this, you might, as soon as I start saying this, you'll start to think, oh yeah, this client, that client, they've got this same sort of scenario, this same sort of issue, you could say. And what that is large amounts of cash starts to build up. Business is doing well, cash is coming in, cash flow is good, reserves are building up, cash in the bank account building up as well, cash sitting on the balance sheet. And what this particular business owner wanted to do is to start to branch out. And what he wanted to do is to begin building his property portfolio. So begin investing in UK property specifically. We've seen clients with overseas property as well, but we'll leave that for another video. Wants to invest in UK property. I think his brothers and his father, they were already in the property market. And, this individual, this business owner, he always had plans to, expand into the property market as well. Now, the issue was, so now we've introduced the scenario, I'll explain what they were going to do, and then we'll come back to what we advised them on and where the tax savings were created. So make sure you watch to the end. What they done is the business owner and the accountant, they had a discussion. They had multiple discussions. And what the plan was, because look, without having a tax partner on your side, or without getting professional expert tax advice, it's very easy to, do something that is the norm or something that makes sense to you. Or you might go onto the internet and read up something and think that works for you as well. So just yesterday, I think, or the day before, I was speaking to a client and he had watched some videos, he had read a few articles, and, I had to explain to him that basically what you've read is correct, but it doesn't suit your scenario. It doesn't suit your circumstances. So going a bit off topic there, but I think it's very important, especially when making larger transactions, or if your business starts to make profit, it's very important to have a tax partner on your side. We work very closely with business owners and accountants. So the plan was to withdraw cash by way of dividends so that the business owner can purchase the property in a personal capacity. Now, there's many issues with that. And so ignoring the tax issues, there's also commercial issues with that, in the sense that, it's a buy-to-let property and you owning it in your personal name and you're paying large amounts of tax to withdraw the funds. So if the value of the property quite specifically was in the region of £300,000. Now, if you want cash, if the property is worth £300,000, you need cash available after tax of £300,000. So that doesn't mean you withdraw dividends of £300,000. Why? Because there'll be tax payable first, and then, so after tax cash, that's what we need. So if you do a quick working, roughly speaking, for this particular client, he would have had to withdraw at least £425,000 in cash, minimum 425,000. I think it was more, but for the sake of simplicity, we'll say 425k. And then those dividends would have been heavily taxed via the self-assessment tax return. And let's just say again, it was more than 125k, but we're using 125k as this example. 125k would have gone to the taxman even before any asset has been purchased. Even before the cash has come, 125k is gone. Now, 125k is serious money. You can probably buy another property with that amount. So they had the discussions, and proactively they realized that there must be a better way, and that's when we were approached. So what we then went and did, we obviously we don't just say do this, do that straight away. We look at matters closely. I wanted to understand his longer term plans. One thing that it was important to understand is he buying this property for himself or for a family member or for buy-to-let purposes? Because if you're buying it for yourself or for a family member, then it's probably not ideal to purchase it in a company, which is what we'll come to that. So we understood the client's plans, his longer term goals, what is he doing with the trade, and that's a key point we'll come to as well. As I say, we don't just think on the spot and start giving solutions. You have to think of the whole circumstances. That's something very important. It sounds basic, but many accountants and advisors, they sometimes overlook this point, which is, longer term, medium term, long term. What's the plans? So once we got to the bottom of that, it was the ideal scenario. It became pretty obvious that what we should do is set up a group structure. Okay, so we had the trading company sitting alone. What we advised is we introduce a holding company on top of the trading company by way of a share-for-share exchange. Dividends between companies are exempt for corporation tax purposes. So a dividend from TradeCo up to HoldCo, and HoldCo then purchases the £300,000 property, £125,000 tax saved. Sounds good? Sounds easy? It's not easy. It's not straightforward. There's a mechanism for this whole process, and you should take professional advice. But for what's the word? I forgot the word. But anyways, by basically introducing a holding company, we eliminated a £125,000 tax problem. I hope you're smiling. I hope you're happy. Now, the reason this worked out perfectly is in the next 2 to 3 years, this client, he intends to sell his trade, get rid of the trade. His son and daughter, they're not interested in continuing the trade. He is going to make a third-party sale, most likely, and continue or focus on the property side of things. Why does this work perfectly? Because this allows now for access to something called the substantial shareholding exemption. Okay, it's a complex area of tax that that needs to be demystified, but effectively, in a nutshell, is the potential sale of this trade. Okay, and we're talking profits of close to 2 million projected. So we haven't done a valuation yet, but the valuation will come out high for this trade. potentially tax-free sale. It's just getting better and better, right? Potential tax-free sale, subject to conditions being satisfied, but the holding company because the holding company now owns 100% of the trading subsidiary. The holding company disposing of shares in a trading subsidiary can allow for a CGT-free sale. That is a win-win situation for the client. Obviously, we don't know what's going to happen in the next 2-3 years for sure, but most likely the substantial shareholding exemption will come into play. And what that happens, so for example, let's just say, for argument's sake, he sells the business for £2 million. So even if he claimed business asset disposal relief, you'd still be paying around £300,000. Why? Because 1 million lifetime, and then the balance 1 million at 20%. So 1 million at 10%, 1 million at 20%, which is £300,000. If you don't claim business asset disposal relief, then it'd be £400,000. So effectively, we saved £125,000 now, but we've also potentially, most likely saved him £400,000 in UK corporation tax or capital gains tax. Yeah, capital gains tax, 20% on £2 million, and these are just estimated projected figures. Rather, so effectively, the after-tax proceeds would be about 1.6 million, let's say. £400,000 going to the taxman. Now, what will happen is the holding company, just think about this clearly, the holding company will dispose of its shares in the trading subsidiary for £2 million to third-party purchaser, and holding company will receive full £2 million proceeds. This £2 million can then be used to fund further properties. And now we have one standalone holding company. We can, there's so much we can do now with that. We can plan for inheritance tax, for example, because if you're purchasing properties for 2 million, you're over the IHT threshold, 40%, property values constantly increasing, IHT nil rate bands fixed, frozen till 2028. If there's mortgages in place, then mortgages have been paid off. So 40% inheritance tax on death, that's building up. We can look to introduce some sort of tax planning there. Family investment company, introduce some trust potentially. He does have 2 children, and growth and freezer shares, for example. So there's a lot we can do. But the key point for this video was the £125,000 tax saving, and an added bonus, which I'm sure you weren't aware of, as in you didn't expect it to come up in the same video, is the substantial shareholding exemption. As I say, my name is Omar. I am a chartered tax advisor and regulated by the Chartered Institute of Taxation. We're starting to assist many clients with their complex tax issues. Bring me a complex tax issue and I'd enjoy it. So it's on your mind, it's causing you headaches, it's causing you stress, nobody's really coming with a proper solution. This is what I do. I do this day in, day out, and this is what we can do as a firm. We can help you navigate UK taxes. It's not straightforward. You have CGT, income tax, corporation tax, capital gains, that's the standard ones, and then stamp duty, land tax as well. So we've got good knowledge on stamp duty, land tax. There's about 45 reliefs there. Most people know about 2. Property investors, property developers, we work closely with business owners. Throughout the whole stage of your business cycle, there's something we can look at. And of course, succession planning, inheritance tax, international tax issues, looking at the GCC, so looking at Dubai, for example. Anyways, I won't make this video too long. Don't forget to like, comment, share, and subscribe. I hope you found this video beneficial and useful. I shall speak to you soon. My email address is down below.